Good evening. Welcome. If you're watching this later, welcome to the people who are watching us later. I'm Shannon with the Shannon Jones team at Keller Williams Realty in Long Beach. And here with me this evening, we've got Brad Jones, who is my husband and business partner, and Julie Aragon from the Aragon lending team. So, we're excited to be doing this because we have been hearing from a lot of people that they have concerns about buying now. And of course, ironically, earlier this year and last year, the concerns that we had from a lot of people were that there were too many bidding wars and they didn't want to pay above the list price. And the concerns now are different because, of course, our market has changed significantly. Rates have gone up and the market has shifted. So we're going to talk about that. Let me go ahead and share my screen here. Okay. So should you buy a home with today's interest rates? Let me see first too. I want to see if I can go live on YouTube. I will figure this out here in a minute. All right, maybe I won't figure that out. We'll share it later on YouTube. Okay, so should you buy a home with today's interest rates? And there you go, meet the experts. Let's talk about what's going on with the market and the changes we've seen and how it impacts you as a buyer or a potential buyer. So the first thing we've seen a change in, obviously, is inventory. And a lot of people look around and they say there's a few more homes on the market, and we'll take a look at that. We've also, I guess I need to move forward. We've also seen a change. Let's see. We've also seen a change in demand.
There we go.
Yeah, there we go. Technical difficulties, sorry. And the time on the market, and we'll take a look at that. And the list price to sales price ratio. And that's where you'll see a big opportunity. As a result, we're having fewer offers on homes, and we're going to take a look at how that's actually really impacted sales prices. So let's take a look at some of the actual numbers, because I think if you read the news or you watch TV news, what you're looking at is trends that are national, and you're not really seeing how it's impacting the local market. And real estate is very local. You don't want to buy a house somewhere if you're thinking about buying. You want to buy a home in a specific community. So let's look at what's going on in our community. So these are numbers for single family homes in Long Beach, but they do look a lot like what's happening in Southern California. They're just very specific here. So what you can see is that earlier this year and late last year, inventory was far lower than it is now. And yet, as of October, we were at a 1.9 month supply of homes in Long Beach. And what that means is if no other homes came on the market, in less than 2 months, we'd be totally sold out. So technically, that's still a seller's market. But what it means is for you as a potential buyer, you do have more choices than you had earlier this year or than you had last year. So that's definitely beneficial for buyers. We're in a bit more of a balanced market. The next thing that I want to show you is what's happened then to the length of time it takes to sell a home. So back here, the median time was 7 and 8 days. As a buyer, when you saw a home, you needed to act quickly, you needed to act decisively. And now, we're at 20 and 19 days is your median time on the market. If you look at the average, it's even a little bit longer. You're at 28 days. So that gives you a little bit more breathing room to make some decisions. Not in every case, because homes that are priced well, that are attractive and well located, do still sell quickly in any market. So the homes you love the most, probably other buyers will also love the most. The next thing I want to look at is how has that impacted sales prices? So let's look at average. What you can see is in April, we had a peak. 1,173,527 was the average sales price for a house in Long Beach. And it's declined since then. But the last 2 months, we've seen some slight increases. And if you look at October's number, which is a little above 1 million, that's still 8.7% higher than it was last October. So there's some perception that prices have absolutely plummeted. Well, sure, prices are lower than they were earlier this year, but where are they going? If you are a buyer and you are waiting to hit the bottom, I'm going to wait until prices hit the bottom. Where is the bottom? Was it here? Or are we going to go further? It's hard to say. And we'll look at in a minute what some experts are predicting. But what I want to point out is that prices don't do this and they don't do that. They don't go up and down in smooth lines. And so predicting exactly where you will be best off buying is a challenge. What we know, though, is that rents do this. And so if you're renting, you can pretty much count on your rent to go up. Whereas if you're able to buy a home with a monthly payment that works for you, you're locking that amount in and you're not going to have to see this kind of up line in the future. You may even be able to refinance in the future and have it go down. And Julie will go into that in a minute. But that's where we are in sales price. I want to look at one more graph before we move on, because this is where the opportunity lies for you as a buyer, as a potential buyer. And that is the percentage of original list price. So what you can see is that back in May, on average, sellers could put their home on the market, go to average instead of median. On average, in April, May, sellers could put their home on the market and expect to get more than 105% of the list price. And that means that buyers who are making offers could expect to pay more than 105% of the list price. And there were many homes where sales prices went way above the list price, not just $5,000, $10,000, but $20,000, $50,000, $100,000 more than the list price was not uncommon. And now you can see that we went down to 97.4%, 97.5% in September, October. So for you as a buyer, this is like a sale. If you like sales, this is a good time to buy a home, because there's now some opportunity to kind of roll up your sleeves and do some negotiating. We have some clients recently who have been able to negotiate their offers significantly below the list price. And we've had appraisals that have come in well above what they were paying. That's because they're taking advantage of the current sale on homes. And you can too, if you know what you're doing. So the next thing I think that's important to look at, though, is, because this is scary for people. What if I buy and, and prices go down? What is ahead? What's going to happen? So I'm going to go back into my slides, and we're going to look and see what do economists say about what's ahead, because I don't have a crystal ball. I'm not psychic. Unfortunately, it'd be nice if I was. But let's look and see. So if you look at what Mortgage Bankers Association and National Association of Realtors and Fannie Mae and what a number of other experts say about what's going to happen to home prices, you can see that some of them say we're going to still have moderate increases in home prices. And some of them now are saying that we are going to see some declines. And if you average these 5 forecasts, you get to a 0.2% increase in home prices, which in my mind means that we're expected to be relatively flat, either a slight increase or a slight decline, depending on who you talk to. And so again, the key is to really look at, okay, if I was going to buy now, given the fact that rates are higher, what would I need to do? And for that, Brad's going to talk about how you might want to adjust your approach if you wanted to buy now.
Okay. And so how can you adjust your approach? You see the 3 things here. You could reevaluate your budget, and that might be something you could change. You might be locked into a budget that you need to work with, and that's fine. What else could you do? Reconsider the home criteria. We'll get into that in a little more detail on the next slide. And then review the available loan options. Maybe your budget is set, but there might be some financing options that Julie could review with you and say, here's some different things that would still allow you to buy that home at a price that works for you. So, but what's the most common thing that you're able to do? Well, you could reconsider the home criteria. And this is what we're talking about here. Area is one thing that you can maybe change. A lot of people are now able to work remotely, or you might just be willing to look in a different area or commute a little further to work if you still have to go to work. So area is one thing that you can certainly change. The property type, maybe you want a single family house, but it's maybe just a little out of reach in an area that you really want. Well, maybe area is most important to you. So you might say, well, I would consider a condo or a townhouse if I could stay in this location. So what type of property you look at is something that you can take into consideration. And then you can get into the property specifics. This is kind of the nuts and bolts. You know, how many bedrooms, how many bathrooms? I'd love to have a 3-bedroom, 2-bath or a 4-bedroom, 2-bath. But could I live with 1 bath, you know, for a short period of time? Maybe there's some remodeling opportunities. Size of the house. Yes, I'd like a larger house, but maybe to get into my first house or my next house, I'd be willing to reconsider the size. And then all the other things, the features of the home. Maybe if you're willing to roll up your sleeves and do a little TLC to the house, you might be able to find an opportunity. It might not be move-in ready, but you could add some value by fixing it up yourself. So a lot of things that we could go over. Once you establish your budget, then we can more specifically look at areas, home types, home features, and help you find your next house. So I think Julie can now jump in and talk to you about all those financing options that we've kind of talked around here so far.
Yeah, let's do it. Okay, so mortgage rates. It's a chart over the last 12 months. A year ago, we were looking at rates in the low 3s, and they went up, and they went up quick. Like before we knew it, we were 5, 6. Now we're, just under 7% for a 30-year fix today. And so we know that's affected affordability. So what are we going to do to still get people into homes because people still need to buy. So there are a lot of programs now or strategies that we're doing with clients in this market. So Shannon, next slide. Okay, WTF, what the Fed? So Fed had their meeting today. They raised rates another 3/4. That was no secret. We all knew, the market kind of already baked that in. But there is another meeting that's coming up in December, and whispers around is that the Fed may not do another 3/4 hike in December. What that tells us is the Fed believes what they're doing is working, okay? And what they're doing is trying to slow down the economy. They want us to keep our butts at home, and they're gonna force us into a recession to get a hold of inflation, okay? So we've got this picture of Family Ties, one of my favorite shows, came out in 1982, the year I was born. And if you're my age, or somewhere near it, we always hear our parents say, oh, when I bought my first home, rates were 18, 17%. But they bought a home, because they needed a place to live. So we are, so that was during a high period of inflation. And what we saw was, once we headed into a recession in the early 80s, interest rates dropped. By mid to late 80s, interest rates had declined about half of where they were at the peak. So there is an opportunity for us. Next slide. Oh, Shannon. Okay, next slide. If you're that old. Okay, so one thing to do is consider an ARM. Now, an ARM is where you have a fixed rate period for maybe 5, 7, 10 years, and then it becomes an adjustable. So it allows for a lower initial monthly payment than a 30-year fix. And if and when rates drop, you have an opportunity to refinance. So if well, this is just going to be my starter home, we're going to maybe plan a family and outgrow it, so I'm comfortable with going in for a 5-year fix, this is what this could do for your purchasing power. So the first column is a 30-year fix, 1.3 purchase price with 20% down. So 30-year fixed rate, 6.375, that would give you a total monthly payment of $79.67. Okay, now if we consider an ARM, that rate would drop to 5.9%, which would lower your payment to $76.47, and that would be a monthly savings of $319. Now, what does that mean for you? Well, in this scenario, that means $53,000 more home. So as Brad was saying, adjusting that criteria when you need to, well, in some cases, maybe that $53,000 can get you that extra bathroom that you really want or need. So an ARM is a really good approach or a really good strategy to look at when looking at affordability. Okay, next slide. So this one is one of my favorite strategies in a market where interest rates are going up, but we kind of believe that this is temporary, that we may see them go down, and it's called a 2-1 seller-paid buydown. So I'll repeat, seller-paid. Okay, so this is where we negotiate, as Shannon was saying. Now we've got some negotiating power where we ask a seller to give us roughly a 2% credit for closing costs, and we're going to use that credit to buy down the rate in the first 2 years to make the payment more affordable. Okay, so in this scenario, I'm going over an $875,000 price. We ask the seller for a $16,000 credit. That gets you an interest rate in the first year at 4.75. Monthly payment is $46.37 per month, which is an $888 monthly savings versus you did a traditional 30-year fix. Okay, and that's in
pretty
year
significant.
It is. In year 2, your interest rate's going to go up by 1%. So your payment will go up to $5,071 per month, which is a monthly savings of $455 per month. And then in the 3rd year, the highest it could ever go up is 6.75. So there are some people in the camp of, I'm not going to do an ARM. My parents lost their home in an ARM. I'm staying away from that. This is like a hybrid where you have a couple of adjustments, but then it can never go over 6.75, and you would have a fixed payment after that. And a lot of families, they might be in a situation where it's like, they need the lowest monthly payment right now, but they know that they're in for some payment raises over the next couple of years, or maybe they have a child who's going to be out of daycare and into public school at year 2, maybe a spouse going back to work. There's, they just want that lower initial monthly payment so they can stop renting. And they can manage if the payment goes up to, let's say, the 5526. And what I like to show the example of, this $16,000 can be really powerful to somebody's monthly budget or home budget. If that 16,000 was applied to a price reduction, because right now we're starting to see, right? Like, oh, lowered $10,000 or $15,000 price reductions. Well, in this example, if this $875,000 house was reduced by 16,000, sold for $859 at today's 30-year fixed rate, the payment's $54.29. That only lowers your payment $97. That's not going to move the needle for a lot of people. So this strategy can really help increase purchasing power. In this example, to the tune of $118,000. So now it's like we're getting in that zip code we want, that school district we need. It's really meaningful.
Mm-hmm. And I think the key is that this wasn't a strategy that was available when rates were lower and demand was higher. Mm-hmm. Because if you asked for anything out of the ordinary, your offer was going to go to the bottom of the pile. Mm-hmm. And now that, kind of the tables are turned, as a buyer, you can have more flexibility to structure the transaction so that it works for you.
Yep.
So,
absolutely.
Yeah.
Okay. Next slide.
Yep.
Okay. So we have clients who, were pre-approved last year, and maybe their offer wasn't accepted. And some of them now are kicking themselves like, but my coworker got 3.25 and they're, pissed off thinking they really missed the boat. Well, this example will show, like, as Shannon touched on, homes were selling for 5-10% over list price easily a year ago. So let's say your coworker, there was a home listed for 900. He paid 100,000 over asking, so $1 million with 20% down at 3.25. It's a very sweet rate. That monthly payment, $46.23. Okay, now there's you, and got a home listed for 900. It is not uncommon to get it for 5% under, or 3%. So 875, I see it all the time. Clients are negotiating, they're getting it under asking. So in this example, put the same 200,000 down at a 30-year fix, 6.75. This isn't even factoring in, we do the 2-1 buy down, the numbers get even better, but let's just say 30-year fix. The payment goes to $53.89. So it is $766 more per month right now. But that's not to say that it's forever, because we know interest rates change. And like Shannon said, we don't have a crystal ball, but if we look at the last 40 years and see in history, every time we've headed into a recession, what happens to mortgage rates is they decline. So, well, we don't know where they're going to go. Just for illustrative purposes, let's say they go to 4.5, 875 in 18 months. Okay. So in 18 months, you paid 875, you borrow 675, you owe 664,000 in 18 months. If interest rates drop to 4.5, your payment's going to go down to $43.75, which is $247 less per month than your coworker.
If you refinance.
If you refinance. Mm-hmm. Yeah. And you owe 664,000, they owe 775,000. So while you hear the headlines and you feel like sometimes like it's a terrible time to buy, if you look at the numbers, it's not that bad. It's actually a great time to buy, especially if you can get it on sale. I love a sale.
Yeah, I think the key is there are opportunities in every market. And so there are different opportunities now than they were a year ago. A year ago, the opportunity was the low interest rates. Mm-hmm. Now the opportunity is you've got some negotiating power, and you can lock in the prices and actually, maybe get the house that you wanted and not have to bid against so many buyers. And there are still some financial options that can allow you to buy it today versus becoming a forever renter. So,
mm-hmm.
And in this market, there's a little more protections for buyers, because we're not in a position in every case where you have to waive appraisal contingencies and things that were being done, a few months ago.
Yeah.
So,
So yeah, let's not try to time the market. Like Shannon said, that, you know, where is the bottom? We know over time, real estate always goes up. So while there might be, you know, some little fluctuations, you need a place to live, and there's still really great benefits like the principal reduction, you know, having your money, building equity that way. There's great tax benefits, writing off the property taxes and the mortgage interest, and then the appreciation over time.
Absolutely. So if you wanted to buy now, what should you do? And why should you buy? So the reasons to buy now, one is, as we've said a few times, you have more negotiating power, and you're also able to protect against inflation. So you're buying a house that is the price it is. And what you owe isn't going to go up. It's only going to go down. And your monthly payment is going to be set. You know what it is. You're not at the mercy of your landlord, who can increase it 10% and then another 10%. And, you know, or decide to move back in, and now you've got to look for another place and everything else is more expensive. You are protecting yourself against that unknown. And there's more home options now than there were. There's more inventory, more for you to choose from, and you won't need to waive all of your contingencies. You're just in a much better, stronger position as a buyer now than you were a year ago or 6 months ago. So if you want to buy, what are the steps? First thing is to choose a lender and get pre-approved. And that is a really important part of the process. Especially, you know, if you talk to a lender 6 months, a year ago, with rates changing, you definitely want to re-examine your purchasing power and get some actual numbers. Don't just get online and use a mortgage calculator and try and figure it out. Really talk to a lender. You need a professional for this. And then determine your home needs and find the right realtor to help you with your search. In addition to Brad and I, we have a couple of other agents on our team who specialize in helping buyers find the right home. We've been working in this area since 1998, and we would be happy to help you really do an analysis of what your needs are and help you through the process of finding that home, and help you with your search. So those are the next steps. If you would like to connect with Julie, or you'd like to connect with our team, there's some QR codes there. You can contact us and schedule a call. You can also find us online. Julie's on social media. We're on social media. So if you look for the Shannon Jones team, we're on Facebook, we're on Instagram. Our website is Show Me Home, and we definitely would be happy to connect with you. And Julie, your website is
AragonLending.com.
AragonLending.com. So you can connect with Julie there. And definitely, whatever questions you have, feel free to reach out to us. I'm going to stop the screen share here and look and see what questions we have, if any. It looks like we had a few people who couldn't make it, so we definitely will be recording this and sending this out. But I do have a couple questions here. If I want to buy in January or February, is it too early to talk to a lender or realtor now? And the answer is no. It is not too early to talk to a lender or a realtor now. A couple things. One is November, December is actually it's usually like what I call kind of the secret buying season, even more so this year. But there are some amazing opportunities because a lot of buyers decide to buy in January or February. So if you're looking in November or December, sometimes there are some amazing opportunities. And even if you don't want to buy until, January, February, ideally, if the perfect house came up before then and you saw it online and you hadn't gotten pre-approved, you might miss out. So talk to a lender, talk to a realtor, get everything in place so that whether it's now or it's early in 2023, you're in a position to move forward when you find the right place. Okay, I've got another question here. If I've already talked to a lender, should I talk to another? Will it hurt if I have a second person run my credit? We get
That's a
that
Julie
question a lot.
question.
Yeah, that's
Yeah.
definitely a Julie question.
Okay, so if another lender has ran your credit, let's say, last week, and you talked to another bank, if you have an inquiry within it's the same industry, right? So it's not different. You're applying for multiple different types of credit, but same industry, it's actually not counted against you as another inquiry. So I wouldn't shy away from having your credit pulled within a certain window.
What's that window?
So, the algorithms, they don't really tell you everything. It's like 14 days, but then I've even heard like 30 days. And then if you're unhappy with, the first person who pulled your credit, if your credit is, let's say in the 700s, let's say it's high 700s, an extra inquiry is not going to move the needle in terms of interest rate. And I'll tell you, if your score was a 621, right? So like right at this
Get a copy of the credit report.
Exactly. If
Yeah.
if it fell beneath 620, that it could be like make or break whether you can get the home or not. But when you're in the high 700s, you want to, it's okay to shop around and feel comfortable. The most important thing is feel comfortable and confident with who you're working with.
Yeah, I mean, if your score drops from a 785 to a 780, it's not going to impact your ability to get a loan or your purchasing power.
Or the
Yeah.
type of loan you can get.
Yeah, exactly. So really the best thing is to talk to someone that you trust and say, here's my situation. What do you advise? Is this going to impact it? Because
Right.
it sounds like the timing and the credit rating is going to have an impact on that. So, okay, well, we do not have any other questions, and I think we've gone over everything. So again, thank you to those who joined us live, and thank you to those who are watching us in the future. And Julie, thank you for joining us, and Brad, thank you.
Fun.
Right.
And
Thank you, everybody.
have a great evening.
Thanks.
Okay,
Bye
Bye now.
now.
bye.